Imagine this. You wake up on a beautiful Saturday morning. The sun is shining, the birds are singing, and you decide to go for a walk to your favorite coffee shop. You put on your best shoes, grab your new phone, and head out the door feeling great. The day is full of promise, and nothing seems like it could possibly go wrong. You are simply enjoying the moment, thinking about the warm cup of coffee that awaits you just a few blocks away. The world feels calm and predictable, a perfect start to a relaxing weekend. As you are walking down the street, you see a large puddle up ahead from last night's rainstorm. It doesn't seem like a big deal. You plan to walk around it carefully. But just as you get close, a big city bus speeds past, hitting the puddle with tremendous force. A huge wave of muddy water flies through the air and completely soaks you from head to toe. Your clothes are ruined, your hair is dripping, and worst of all, your brand new phone, which was in your hand, is now sputtering and flickering. The screen goes dark. It's completely broken. This small, unexpected event is a perfect example of risk in our daily lives. You didn't plan for it. You didn't expect it. One moment, everything was perfectly fine, and the next, you were facing a problem with real financial consequences. You have to buy a new phone, which costs a lot of money. You might need to get your clothes professionally cleaned or even replace them. It's a sudden, unplanned expense. In the world of insurance, the word risk has a very specific and important meaning. It isn't just a vague feeling of danger or worry. For an insurance company, risk is the chance or the probability that something bad will happen that they have to pay for. It's the likelihood of a specific negative event occurring, which will result in a financial loss. Think back to the story of the bus and the puddle. The risk wasn't just that you might get wet. The specific insurance risk was the chance that your expensive phone would be destroyed, creating a need for a large sum of money to replace it. Insurance companies look at the world as a collection of these possibilities. They are in the business of managing uncertainty. For them, a risk must be something they can calculate. For example, they can't sell insurance against feeling sad because that's not a measurable financial loss. But they can sell insurance against a house fire because they can calculate the financial cost of rebuilding the house. The risk must be definable, accidental, and result in a loss that can be measured in dollars and cents. Insurance companies are businesses, and like any business, they need to manage their money carefully to survive and be profitable. Their entire business model is built on understanding and measuring risk with extreme precision. If they get their calculations wrong, they could lose a catastrophic amount of money very quickly. Imagine if an insurance company insured thousands of homes in an area and didn't properly calculate the risk of a major hurricane. If that hurricane hits, the company might have to pay out so much in claims that it goes bankrupt, leaving all its customers without the protection they paid for. To avoid this, insurance companies employ experts called actuaries. These are professionals who are masters of mathematics, statistics, and financial theory. Their job is to analyze data from the past to predict the future. They look at how many car accidents happened last year, how many houses caught fire in a certain city, or how many people of a certain age group had major surgery. They use this vast amount of historical information to build complex statistical models. These models help them predict how likely it is for a specific person or property to experience a loss. Let's look at a very common type of insurance: car insurance. When you apply for it, the insurance company wants to figure out the risk of you getting into an accident. They want to know the probability that they will have to pay for repairs to your car, another person's car, or medical bills for someone who gets hurt. One of the biggest factors is your driving record. Have you had accidents in the past? Have you received tickets for speeding or running red lights? A driver with a history of accidents and violations is seen as a much higher risk than a driver with a clean record. Past behavior is often a strong predictor of future behavior. They will also look at your age and driving experience. A 17-year-old who just got their license is statistically far more likely to have an accident than a 45-year-old who has been driving safely for decades. The type of car you drive also matters a great deal. A fast, expensive sports car is considered a higher risk than a safe, reliable family minivan. The sports car is more likely to be driven at high speeds. It costs much more to repair if it's damaged, and it is also a bigger target for thieves. Your location is another key risk factor. If you live and drive in a crowded city with heavy traffic, the risk of an accident is higher than if you live in a quiet rural area with empty roads. Finally, they consider how you use your car. Do you drive 3 miles to work each day, or do you have a long 50-mile commute on a busy highway? The more miles you drive, the more time you spend on the road, which naturally increases your exposure to the risk of an accident. Now, let's think about the risks associated with your home. Homeowners insurance is designed to protect you from the massive financial loss that could occur if your house is damaged or destroyed. The risks here are different from driving a car, but the insurance company's process of evaluating them is actually very similar. One of the most significant risks for a home is its location. Is the house built in an area that is prone to natural disasters? For example, a home in coastal Florida has a much higher risk of being damaged by a hurricane than a home in Kansas. A house in California has a higher risk of earthquake damage. A home near a large river has a higher risk of flooding. Insurance companies use detailed maps and historical weather data to understand these geographical risks and will adjust their policies and prices accordingly. The construction and age of your house are also vital risk factors. An older home might have outdated electrical wiring, which increases the risk of a fire. It might have an old roof that is more likely to leak during a heavy storm. A house built with wood is more susceptible to fire damage than a house built with brick or concrete. Insurance companies will want to know about the materials used to build your home, the age of its roof, and the condition of its plumbing and electrical systems. Finally, they assess risks related to your lifestyle and the safety features you have installed. Do you have a swimming pool or a trampoline? These are considered attractive nuisances because they increase the risk of someone getting injured on your property, which could lead to a liability claim. On the other hand, if you have installed safety features like smoke detectors, a fire alarm that connects to the fire department, or a sophisticated home security system, the insurance company will see your home as a lower risk. These protective measures can help reduce your chances of filing a claim. Health insurance deals with a risk that is deeply personal, the risk to our own health and well-being. The potential financial loss from a serious illness or injury can be staggering, with hospital bills easily running into the tens or even hundreds of thousands of dollars. For health insurance companies, the risk is the probability that a person will need expensive medical care. An individual's age is one of the most fundamental risk factors in health insurance. Generally speaking, as people get older, the statistical likelihood of them developing chronic conditions like heart disease, diabetes, or arthritis increases. Older individuals also tend to require more frequent medical checkups, prescription medications, and are more likely to need hospitalization. Because of this higher statistical probability of needing care, older individuals represent a higher risk to the insurance company, which often translates into higher premiums for their health coverage. Lifestyle choices also play a huge role in assessing health risk. An insurance company wants to know about habits that can impact a person's health. For example, do you smoke? Decades of data have shown that smoking dramatically increases the risk of cancer, heart disease, and respiratory illnesses. As a result, smokers are considered a very high-risk group and will almost always pay significantly more for health insurance than non-smokers. Your personal and family medical history is another critical piece of the puzzle. If you have a pre-existing chronic condition like asthma or high blood pressure, you are more likely to need ongoing medical care and prescription drugs. Similarly, if there is a strong history of certain diseases in your family, like a genetic predisposition to certain types of cancer, your statistical risk of developing that disease may be higher. Insurers use this information to build a complete picture of your potential healthcare needs. The connection between risk and the price of insurance is direct and powerful. The price you pay for your insurance policy, called the premium, is not an arbitrary number. It is a carefully calculated figure based on the insurance company's assessment of your specific risk profile. In the simplest terms, the higher your perceived risk, the higher your premium will be. The insurance company is charging you more because they believe there is a greater chance they will have to pay out a claim on your behalf. It's a fundamental principle of the entire insurance system. Think of it like a big pool of money. Everyone who buys a policy from an insurance company pays their premium into this pool. The people who are considered low risk, like a safe driver with a perfect record or a young, healthy non-smoker, contribute to the pool but are less likely to need to take money out. People who are high risk, like a driver with multiple accidents or a homeowner in a flood zone, are statistically more likely to need to take a large sum of money out of the pool to cover a loss. To keep the pool full enough to pay for everyone's claims, high-risk individuals must contribute more. This is why two people can pay vastly different amounts for the exact same type of insurance coverage. This pricing model also creates an incentive for people to be safer. If you know that getting speeding tickets will make your car insurance more expensive, you might be more inclined to obey the speed limit. If installing a security system can lower your homeowner's insurance premium, you have a financial reason to make your home safer. In this way, the pricing of insurance not only reflects risk, but can also actively encourage people and businesses to take steps to reduce their risk, which ultimately benefits everyone in the insurance pool by leading to fewer and less costly claims over time. While insurance companies spend a lot of time assessing our risk, the good news is that we are not powerless. There are many practical steps we can take in our daily lives to manage and reduce our own risk. This is often called risk management or loss prevention. By actively working to lower our risk, we not only make our lives safer, but we can also often lower the amount we have to pay for our insurance premiums. It's a win-win situation where we gain both greater safety and financial savings. For car insurance, the steps are straightforward. The most important thing you can do is to be a safe and defensive driver. This means obeying traffic laws, avoiding distractions like texting while driving, and not driving under the influence of alcohol. Maintaining a clean driving record free of accidents and tickets is the single best way to prove to your insurer that you are a low-risk driver. You can also choose to drive a car that has high safety ratings and is less expensive to repair. Some insurers even offer discounts for completing a defensive driving course. When it comes to your home, risk management involves both maintenance and upgrades. Regularly inspect your home for potential hazards like loose railings, frayed electrical cords, or a leaky roof, and fix them promptly. You can significantly reduce your risk of fire by ensuring you have working smoke detectors and fire extinguishers. Installing a monitored security system can lower your risk of theft. If you live in an area prone to storms, you can strengthen your home by installing storm shutters or reinforcing your garage door. These actions make a major loss less likely. For your health, managing risk means adopting a healthy lifestyle. This includes eating a balanced diet, getting regular exercise, and avoiding tobacco products. Regular checkups with your doctor can help catch potential health problems early, when they are often easier and less expensive to treat. Managing stress and getting enough sleep also contribute to overall well-being and can reduce your long-term health risks. By taking control and making safer, healthier choices, you are not just hoping for the best, you are actively shaping a future with less risk and more security. Let's end with a story about a family, the Jacksons, who lived in a quiet neighborhood for over 20 years. They had always been responsible people. They paid their bills on time, including the premium for their homeowner's insurance. Sometimes Mr. Jackson would look at the bill and wonder if it was really necessary. Their town was peaceful and nothing bad had ever happened. The money they spent on insurance every year felt like it was just disappearing, paying for a problem that never seemed to arrive. One summer, a powerful and unexpected storm developed in the region. Meteorologists warned that it was a once-in-a-generation weather event. The winds howled with incredible force, and rain fell in sheets. The Jacksons huddled together in their basement, listening to the terrifying sounds outside. In the middle of the night, they heard an enormous crash. When the storm finally passed the next morning, they went upstairs to find that a huge, ancient oak tree had fallen, crashing right through their roof and into their living room. The damage was devastating. In that moment of shock and despair, seeing their beloved home torn apart, a sense of panic began to set in. How would they ever afford to fix this? The cost of removing the tree, repairing the roof, and rebuilding the living room would be tens of thousands of dollars, money they simply did not have saved up. But then, Mrs. Jackson remembered the insurance policy. They made the call to their agent, their voices trembling. The agent was calm and reassuring, and immediately started the claims process for them. Within a few days, an insurance adjuster visited their home to assess the damage. Soon after, the Jacksons received a check from their insurance company that covered the full cost of the repairs. A construction crew came and removed the tree, rebuilt the roof, and made their living room look brand new again. That bill they had paid every year, the one that sometimes felt like a waste, had transformed into a safety net that caught them when they fell. It didn't erase the scary memory of the storm, but it allowed them to rebuild their home and their lives without facing financial ruin. They had peace of mind, knowing they were protected.